This morning, everything changed. President Trump announced the U.S.-Iran Memorandum of Understanding will be signed today. The Strait of Hormuz, closed for over 3 months, will immediately reopen. The Strait of Hormuz, closed for over 3 months, will immediately reopen. This is the single biggest geopolitical development of 2026, and it is going to move every asset you own in the next 48 hours. Today, we walk through exactly what happens to gold, oil, stocks, bonds, and real estate, step by step, asset by asset. No guessing, just the data. Before we talk about markets, let us understand what was agreed. The 14-point memorandum has been confirmed by both Iranian and U.S. officials. Pakistan's Prime Minister Shehbaz Sharif confirmed finalization was expected within 24 hours as of Saturday. The core terms are straightforward. Iran immediately opens the Strait of Hormuz with no tolls charged. The U.S. lifts its naval blockade of Iranian ports in parallel. Full restoration of pre-war shipping is expected within 30 days. On the financial side, the U.S. releases $24 to $25 billion of Iran's frozen assets. All oil sanctions on Iran are waived until a final deal is concluded. Iran receives sanctions relief only as it delivers on commitments. That conditionality makes this deal significantly more durable than the 4 previous ceasefires. On the nuclear side, Iran commits to not producing or purchasing nuclear weapons. It will enrich no new uranium and will dilute its existing stockpile. Trump confirmed Iran no longer wants to pursue a nuclear weapon, a significant diplomatic breakthrough beyond just the Hormuz question. Oil will be the first and fastest market to react on Monday morning. Even before the deal was signed, when Trump signaled a deal was near on Friday, oil immediately fell below $90. U.S. crude futures dropped to $84 per barrel by Saturday morning. Brent crude sank to $87. That is a $10 drop in less than 24 hours on optimism alone. Now that the deal is confirmed, the data tells us where oil goes next. The pre-war price of Brent crude was approximately $71 to $73 in early February 2026. The war added a $25 to $30 geopolitical risk premium at its peak. A confirmed deal does not remove that premium overnight. Rystad Energy confirmed. Recovery time equals outage duration. The strait has been disrupted for over 3 months. Sea mines must be cleared, infrastructure repaired, tanker schedules restored. Full supply recovery will take 2 to 3 months minimum. The realistic oil price range for the next 30 days, $78 to $88 per barrel. The 6-month target, assuming the deal holds, is $72 to $78. For investors holding energy stocks, ExxonMobil, Chevron, BP, expect near-term pressure on earnings expectations. The energy sector trade that worked from February to May is now reversing. Gold is the most complex asset to analyze in this scenario. The conventional wisdom says peace deal means gold falls immediately. War premium removed. Safe haven demand drops. Gold crashes. That conventional wisdom is partially correct, but dangerously incomplete. Here is what actually happens, in 3 phases. Phase 1, the immediate reaction. Monday through Wednesday this week. Gold will fall on deal confirmation. The war premium, estimated at $300 to $500 per ounce, begins unwinding immediately. From Friday's close near 4,218, gold could drop to 3,900 to 4,000 in the first 48 to 72 hours. This drop is mechanical, not fundamental. Phase 2, the FOMC overlay, Wednesday, June 17th. If oil falls to $84 and holds there, May CPI of 4.2% begins to look like the peak. June CPI, released in mid-July, could print at 3.4 to 3.6% if oil cooperates. That inflation moderation gives the Fed cover to signal no rate hike. No rate hike signal removes the second major downward pressure on gold. Gold stabilizes. The 3,900 to 4,000 floor holds. Phase 3, the recovery, 30 to 90 days post-deal.
The structural drivers of gold have not changed. China's central bank has bought gold for 18 consecutive months. Global debt is at historic highs. Dollar trust continues declining among non-Western nations. Goldman Sachs maintains its $5,400 target. JP Morgan holds its $6,000 target. Both targets are built on the structural case, not the war premium. The deal removes the war premium. It does not remove the structural case.
The stock market reaction to a confirmed deal will not be uniform. There will be clear winners and clear losers, and understanding that split is where the real opportunity lies. The losers, immediately. Defense contractors, Lockheed Martin, Northrop Grumman, Raytheon, surged during the war. A confirmed peace deal reduces near-term government defense orders. Expect 5 to 8% near-term pullback in defense sector ETFs. Energy producers, ExxonMobil, Chevron, Shell, face lower earnings per barrel. Analysts will immediately revise Q3 and Q4 earnings forecasts lower. Expect 4 to 7% near-term decline. The winners, immediately. Airlines, Delta, United, American. Jet fuel is their largest operating cost. Every $10 drop in oil saves major airlines hundreds of millions of dollars annually. Airline stocks could surge 6 to 12% on Monday's open. Shipping and logistics, FedEx, UPS, Maersk. The reopening of Hormuz restores the most critical global shipping lane. Companies that rerouted around Africa snap back immediately. Technology and AI, the sector least affected by the war. Reduced inflation fears reduce Fed rate hike probability. Lower rate expectations are the most powerful driver of technology stock valuations. Consumer discretionary, retail, restaurants, hotels also benefit as lower energy costs reduce input costs across every business. The S&P 500 broadly, expect a 2 to 3% opening rally Monday, but select your sector exposure carefully. Defense and energy lag. Airlines, consumer, and tech lead. This is the asset class most investors are completely ignoring right now, and it may be the biggest opportunity the deal creates. Here is the logic, step by step. Pre-deal. Inflation at 4.2% forced the Fed to consider rate hikes. Higher rate expectations pushed Treasury yields higher and bond prices lower. Bonds had a terrible spring. Post-deal. Oil falls to $84. Inflation expectations fall. Fed rate hike probability drops significantly. Lower rate expectations push Treasury yields lower. Lower yields mean higher bond prices. This is the first scenario in months where buying long-duration Treasury bonds makes genuine sense. The 10-year Treasury yield currently sits near 4.5%. If the deal holds and July CPI prints at 3.5%, that yield could fall to 4.0 to 4.2% within 60 days. A 0.4% yield decline on a 10-year bond produces approximately 3 to 4% price appreciation, on top of the 4.5% annual yield you collect. Total return in 60 days, potentially 5 to 6%, risk-free. This is the trade sophisticated investors will be making Monday morning. The 10-year Treasury yield currently sits near 4.5%. If the deal holds and July CPI prints at 3.5%, that yield could fall to 4.0 to 4.2% within 60 days. A 0.4% yield decline on a 10-year bond produces approximately 3 to 4% price appreciation, on top of the 4.5% annual yield you collect. Total return in 60 days, potentially 5 to 6%, risk-free. This is the trade sophisticated investors will be making Monday morning. Real estate is the slowest of all assets to respond, but the deal creates a clear chain reaction that eventually reaches mortgages. Oil falls, inflation falls, Fed signals no hike, market prices in rate cuts, mortgage rates begin falling, home buying demand returns. This chain takes 60 to 120 days to fully play out, but the starting gun just fired today. Mortgage rates currently sit above 7%. If the Fed signals no hike at FOMC and inflation moderates, Mortgage rates could fall to 6.3 to 6.5% by August. That still sounds high, but for buyers locked out of the market, it is a meaningful improvement that restarts transaction volumes. For real estate investors, REITs focused on industrial, logistics, and data centers are best positioned to benefit first. Residential demand recovers more slowly as mortgage rate relief works through the system. Begin your property search now so you are ready to act when rates fall in Q3. Here is the exact framework for every type of investor this week. If you hold gold, do not panic sell on Monday's initial drop. The war premium unwinds, but the structural case remains. 3,900 to 4,000 is likely the floor, not the start of a collapse. If gold reaches 3,900 and you believe Goldman's 5,400 year-end target, that is a 38% upside from that entry. Scale in between 3,900 and 4,100. Do not deploy all at once. If you hold defense and energy stocks, review your position size before Monday's open. The trade thesis has changed. Defense and energy were right during the war. Post-deal, airlines, consumer, and technology are the new leaders. A gradual rotation over 2 to 4 weeks is appropriate, not a panic exit Monday. If you hold cash, this week may be one of the best deployment opportunities of 2026. 3 targets in order of priority. First, short to medium-term Treasury Bonds. Lock in 4.5% yield before rates fall further. Second, airline and consumer sector ETFs, direct beneficiaries of lower oil. Third, gold below 4,000, if we get there. The structural case justifies a long-term position at that level. The Iran deal changes the investment landscape of 2026 in 5 specific ways. Oil falls from 94 towards 78 to 84 over the next 30 to 60 days. Inflation begins moderating. June and July CPI should show meaningful improvement. Fed rate hike probability falls. FOMC Wednesday becomes significantly less hawkish. Stocks rotate. Defense and energy out, airlines, consumer, and tech in. Gold falls initially, then recovers on a new structural thesis, not the war thesis. The key dates this week. Monday, June 15th. Gold's opening price sets the tone. Watch 6 a.m. Eastern. Wednesday, June 17th. Kevin Warsh's first FOMC decision. If Warsh acknowledges that deal-driven oil relief will reduce inflation, that is the most dovish signal he can give. Gold recovers, bonds rally, stocks surge. This is the scenario we have been building toward all month. And before I close, the reminder we give on every video. Everything here is for informational purposes only. This is not financial advice. All data is based on publicly available information as of June 14th, 2026. Please consult a qualified financial advisor before making any investment decisions. All information is purely for your reference, to help you think clearly, not to tell you what to do. If today's deep dive gave you the clearest picture yet of what this deal means for your money, please give us a like and hit that follow button. Monday, we open FOMC week with the deal confirmed. Wednesday, Warsh's decision. Your financial future matters. Stay informed, stay ahead. Financial News Daily.